Thanks for tuning in for this month's Best Moments of the Futures Radio Show podcast. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show podcast on iTunes, YouTube, Google Podcasts, Spotify, or Stitcher. This show is also sponsored by Trading Technologies, RJO Futures, and FTSE Russell. The Russell 2000 is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Futures symbol, RTY, and Micro E-Mini Russell 2000 Futures symbol, M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Why exactly did you decide on channels? Talk to us about some of the rules and just how your strategy and process works.
Okay, so I finally realized that whatever I was doing, the algos knew what I was doing ahead of time, and that was what I would do ahead of time, and that was very consistent. So finally, I figured out that if I could find a line on a chart that the algos respected, and if I could take that line and move it around the chart and see that they've respected that slope multiple times, that would be a way to take advantage of how the algos might be taking advantage of other traders. That was my original concept. So I realized that this whole thing is run by computers. We're playing chess against a computer. I'm not going to try to be smarter than a computer. I don't think I can win. But if I can figure out what they're doing to get money from folks, then I can just sort of tag along. And so that was why I chose channels, just because I think conceptually it made sense to me. And I mean, clearly fibs are part of that as well. I don't use them because I don't want to add lines onto my chart. I know anybody listening to this would be like, what? No, but I don't use them. And it turns out though, when I do have, a lot of people say, that's the XX fib level. I'm like, what? Really? That's fantastic. But I wouldn't have known that otherwise. But anyway, so that's why I started using channels. And then I do the same thing. And I used to use also a zillion indicators. And then I stopped using almost all the indicators and just picked, I still sometimes use others, so I shouldn't say I never use them, but I just picked RSI as my go-to confirmation. And so I realized that the same concept of slopes in price being respected over and over again happens with RSI as well. And so I would then realize that if price got to a place where I saw some support in the price action, and if RSI was also at support at that time, that was a good time for me to get in. And then I also started scaling, and that was really about risk management more than anything else, because before, when I would just do a full-on trade and I would put a stop in, it would just catch my stop every freaking time. And so when I started scaling and expecting them, say, well, if I were to have a stop, where would I put it? And then buying the other two scales there or buying one of the scales there, that started working for me. I literally was like fading myself where I would stop out. And that's pretty much what I do.
Range of execution. Yeah, for me, that was a turning point as well. I used to be all in, all out, all the time. And range of execution, scales is something that I really like too. And I want to talk about that a little bit more because I talk a lot about execution, and I think it's not talked about enough, right? You finally have this strategy. You found the channels that you liked. You talked about the RSI, but then you went in and you tweaked your execution. Is that trial by error as well? Like you said, you mentioned how the kind of what the algos, I want to talk about that actually a little bit more as well, and how that kind of determined your execution. just walk us through more of like that range of execution and how you go about scaling.
Sure. So, well, if I'm trying to bottom catch something, I mean, I make fun of myself all the time, calling myself a bottom catcher, a top caller. But if I'm trying to sort of catch the bottom of a range or the top of a range, I am far more likely to be conservative and scale in slowly and then add on confirmation. And so that's pretty much what I do. And so I'll do a third of the trade usually at where I think is the top or bottom. Sometimes, and that's really if it's a trend change, and then add a third on confirmation or 2/3 on confirmation, or add. I don't like to add it when something goes against me, but I have learned to do that. But what I'll do ahead of time is sort of calculate. If I'm only 1/3 in, I don't need to have a stop. But then when I get to wherever I would have stopped with the full position, I know exactly how much lower it could go after that where I would actually stop out then. So I do sometimes add when the trade goes against me. And I know as long as it was part of my plan, I don't have a problem with that. But I'm careful about that because, again, in part of my first year and a half of trading, I would just keep adding to losers. And as soon as I had a winner, I would take profit immediately. But I would just keep adding and adding. And, they say the trend is your friend. And that was a terrible trend for me. Like if something was going down, I was like, it must go up now, right? And so I would take profits from winning trades and I would add it to losing trades constantly. It was the worst thing I did, the absolute worst thing. But that was my psychology. And that was just wrong. And I can see it very clearly in hindsight, but I thought I was getting a deal on things. I was like, if something is this cheap now, I'm going to be rich, and then I'd eventually have one trade taking up almost all of my capital because I just kept adding and adding, and then it kept going down. So yeah, that was bad, very bad.
This is one of those things. You make a great point about when people say these blanket statements like, don't add to losers. Well, I trade in a range of execution. And until that stop is hit, that trade is not a loser. Right? So my range of execution is okay. Yeah. I mean, sometimes I might get a trade that I've already had one or two adds to my initial position that are against me. And then it gets really close to my stop and I go, look I could add some more here. It's still within my risk parameter. And maybe this thing comes off and it doesn't get my stop, even though we're relatively close. That to me is not adding to a loser. If it were to hit my stop and then I were to not get out or then get right back in, that to me is adding to losers. I think that there is a really clear difference between the two.
Oh, I completely agree. And I even tweeted recently that, adding to losers is dumb unless it was part of your plan. And so if it's part of the plan, and also, I mean, it's ridiculous to think that no one has a drawdown. I mean, please, come on, really? Like it goes up immediately every time. Come on now. But I sometimes plan on being wrong. Like I shorted the Nasdaq recently and I knew I was going to be wrong. I absolutely knew it because I knew it was out of control and I planned for that. I literally thought about where I was adding and subtracting the whole time, but I knew ahead of time that it was going to drop. And my own psychology is when something is going very quickly, I get deer in the headlights and I start doing exactly the wrong thing. I'll buy when I should sell, I'll sell when I should buy. So I need to almost, the way I do things, I need to almost be, if I think a big move is coming, I do need to be positioned for that ahead of time. Or not only will I miss the entire move, I will screw the entire thing up like multiple times. And sometimes, if I've made 3 losing trades in a day, I'll just stop trading. I won't think, oh, okay, the 4th trade's going to be great. I'll just stop because that is a bad situation. I'm not thinking clearly anymore. I stop what I'm doing. I, walk the dogs, whatever. And, so anyway, yeah, but I totally agree with you. As long as it's part of your plan going in, I mean, absolutely. That's 100%. I do that.
Dismantling that hidden bias. Man, is this tough. I could do all the homework in the world. And I actually had a week like this not too long ago where I did everything right in my homework. And when I got to the market, it was like everything that I wanted to happen and thought would happen did. And I lost money. And I'm thinking to myself, what am I doing here? And it was just because I had some underlying biases of like, okay, this move's going to extend. I was long gold. I was pressing it into the highs instead of covering it at my area. I can go on and on about the mistakes I made, but because I had that hidden bias, it hurt me. Even though I was right in my trading, my execution was not good. Talk to us about dismantling, how you dismantle that hidden bias.
Oh my gosh. So yeah, I mean, that's really that's kind of, the whole book is kind of trying to get to that. And that this is what you just said. Like, you can have a really good process. You can understand how to think about what are you investing in? What are the possible outcomes? What are the probabilities? You can calculate out what your expected value is. You can figure out what your downside exposure is, all of that stuff. But if the beliefs that are, sort of informing that process have some sort of flaws to them, we're going to be in really big trouble. It's kind of junk in, junk out. And this is where the cognitive bias problem happens, is that it's really hard for us to fix those cracks in our beliefs, the things that aren't quite right that we think are true, but it turns out they're really just kind of supporting the things that we want to be true. So the main bias that's really, really problematic, particularly in something like trading, is that because there's luck involved, we will reason about what we believe to be true about the world in a way that confirms the thing that we already believe to be true. So if we think that a certain strategy is going to work, the way that we're going to look at the world is going to be looking at that and saying, sort of like looking at all the pieces of information and kind of fitting it to our model, as opposed to changing our model to fit the new information. And once you add volatility into the equation, it becomes really problematic in the short run, because you could have lost because of bad luck. So now this becomes really bad, right? Because it's like, when you win, you're more likely to say, well, I won because I was so smart and my model was so great and I'm such a great trader and look at how smart I am. And when you lose, it's like, can you believe that? I can't believe the market moved that way. Who could have known? That was really unlucky, and you sort of stick to your model. So the best way to actually address that is to get input from other people, but to ask other people in a very particular way. So I'll give you an example from poker, because I'm sure that it will relate, right? If I'm trying to talk about a trade that I made in poker with somebody, the tendency would be for me to say to you, like, Anthony, let me ask you about this poker hand. Somebody raised in front of me, and I would tell you all the details about them, just like I would tell you all the details about the instrument I was trading and, what the market was doing and so on and so forth. So I tell you, like, are they tight? Are they loose? How have they been playing it, but they were winning or losing? How many chips do we have? All the facts that you need. And the usual way that I would do it is this person raised in front of me and I looked down at ace queen. I was right next to them and I raised back. What do you think of that choice? Right. So I tell you what the thing was that I chose to do. But now what I've done is I've already given you the conclusion. So when you give me advice back now, it's going to tend to be to support the thing that I did. It's much less likely that I'm going to get your actual opinion of what I was supposed to do. If instead I say, this person raised in front of me and I look down at ace queen, what do you think I should have done? Oh. Now I get to get your actual opinion. And honestly, yes, it's really hard to discipline bias without doing that. So you can imagine in your situation, you can say, I made this trade, the market did this. What do you think my response should have been? Even though you already made your response, even though you already knew what you did, but nobody, people just don't talk this way. They'll tell you the whole arc of their day. They'll tell you what their, at the end of the day, what their P&L looked like. And then they'll ask for somebody to go back and help them. But that help becomes much less useful because you kind of pull them into your biases.
What is Linda Raschke's edge in your trading?
Oh boy, I've done so much statistical modeling and all. I'm always trying to model, like, where is the momentum, what's going to precede the momentum, how's that swing going to come to an end. So a lot of modeling, and that's what gives you your initial idea. And then I have to say that probably from all my years on the floor in the 80s, I'm really good at tape reading. I'm really good. That's how I can also watch 20 markets at once, because we had to stand on the floor. We didn't have charts, and you're just watching a quote board with 100 different quotes of all the option series, which is how I got my start. So it's just a different way of processing data. And then I think that really my edge is, number one, I have the mathematical edge in my favor, okay, the probabilities in my favor from our modeling, but I also have a really good concentration and focus level. So I think that's a real edge. I don't have TV, I don't get distracted by too many things. And I think for most traders, if they want to improve their trading, just think about eliminating all these outside distractions, and don't, open your email in the morning session and follow people on Twitter and do all that kind of stuff. It's going to take you out of your game. That's really it.
Traders, we're going to pause for 30 seconds and we'll be right back. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Learn more at tryttnow.com. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. To learn more, please visit rjofutures.com. I want to talk to you about your edge today. I've gotten to know you a little bit. You've been on the podcast before. We talked about your process a lot, and I know a lot of our listeners listen to your podcast as well, and I think a lot of people understand, you're macro-based and you trade the spread and crude, but I want to know, how did you find your edge?
That's the most important question, Anthony, for any trader, and you know that. If you don't have an edge, you shouldn't trade. It doesn't make sense to. In my case, it was kind of a bizarre story. I was in the process of reinventing myself as a professional investor. I'd retired from the software industry. I'd been active as a retail trader, a retail investor, whatever. But I wasn't taking it seriously as a profession. And I was very much engaged around 2006, 2007 in reinventing myself as a professional investor. And I joined a high net worth investor club in New York City. Got to know a few people there that were Wall Street veterans. And there was this one guy, Larry, who was kind of a mentor to me. And he had been kind of like Ira Harris is to you. The guy that you sort of clearly has got more experience than you, that you look up to. And he'd always tell me this, he'd set me straight on things. And I'm learning about technical analysis and fundamental analysis and all that. And one day I said to him, I looked at this term structure chart for commodities, and it's different, from the other charts, the price charts. And what I don't understand, my technical analysis book, it doesn't have anything about it. And he's like, really? Your technical analysis book doesn't tell you what a forward curve chart is? I said, no, it tells you what it is. But when you look at the technical analysis, they're looking at these chart patterns, head and shoulders and cup and saucer and all these. And I can't find anything about how to recognize a pattern in that term structure chart. And he kind of scratched his head, and he had this kind of knowing look in his face, like, okay, the kid doesn't get it. He's like, well, Erik, I got to break it to you. I've been in this business, 30 years. And honestly, I never heard of anybody looking at that. And it hit me like a ton of bricks. I'm like, wait a minute. Nobody ever looked at that? Like whatever edge might, and the way I heard that in that moment was, whatever edge might be possible to gain from having insights from the shape of the term structure on the chart and how it might compare to previous term structures that existed before. The whole technical analysis community for all of finance has never bothered to figure that stuff out. That's what you're telling me. That sounds like an incredible opportunity. So I go and I did this interesting Google search where first I Googled Treasury yield curve PhD thesis. And it comes up with like 1,000 pages of search results and a gazillion things. And there's all these guys that did their PhD thesis in grad school on the yield curve, and then they go off to take their proprietary model that the university probably paid them to develop, and they start their hedge fund with it. And I said, okay, let's do crude oil term structure PhD thesis. And it's like nothing, zero. There were matches because Google always finds a match on one of the words in there, but there was nothing that was about that. I'm like, wait a minute, nobody thinks about this? Well, people do think about it quite a bit. Professional crude oil traders, I think, are more engaged in understanding the shape of the term structure and what it means than they are on the flat price, where a lot of retail traders tend to focus. But it's not in the books. You can't find out about this. And it took me quite a long time, actually, because first I started learning chart patterns from my own analysis. I just went through years and years of term structure charts and saying, well, there's this one pattern. I call it a dipsy doodle. That's just the name I made up, where it's like there's this, because it's what it looks like to me. It's like the beginning of the WTI curve. There's about 3 or 4 months, up to 6 months of contango. Then it rolls off into steep backwardation for about 2 years or so. And then it goes into this much more gradual contango after that. And I call it a dipsy doodle because, and I call the little bit on the left edge of it, right at the front of the curve, I call that the beak because it looks to me like a beak on a bird. It's this funny little hook there. And you see that on the WTI chart, but you never see it on the Brent chart. And it took me years to figure out, what the heck, why are they different? Well, the answer is because WTI is a physically delivered contract and Brent is a financially settled contract. And because there's a storage element to it, there's a certain need for the market to price the first few months of the WTI spread into contango in order to allow the guys that are storing oil in Cushing, Oklahoma, to make a buck on that contango yield premium. And, if you don't understand what I just said, you can Google these terms and you'll figure it out. But what I learned is, okay, the storage dynamics in Cushing, Oklahoma are different from Brent, which is this financially settled contract based on the North Sea spot price. And that makes this little beak at the front of the curve happen sometimes, but not all the time. And I thought, well, how come sometimes and not all the time? And the other thing I figured out is, wait a minute, these time spreads, they kind of go through a life where for several years, the time spread is kind of brewing farther out on the curve before it gets up to the front close to expiry. And really, at least in WTI, that's mostly about future expectations of supply and demand. Backwardation, when it exists farther out on the curve, means that in that time frame, if we look 2 years out on the curve, we see backwardation there. It means the smartest traders that are putting the bets on in the marketplace think that 2 years out is a time when there's going to be a lot of demand and it's going to be a tight market. The tighter they expect it to be, the more backwardation is there. But even when that backwardation is the dominant theme, if there's a need to pay to store oil in Cushing, Oklahoma, because there's a little bit of short-term surplus, there almost has to be contango just for the first few months. Well, wait a minute. If you know that's going to happen, but not all the time, only when that beak is there on the front of the curve, you can start to say, wait a minute, what if I short those time spreads, not all the way 2 years out, but maybe 1 year out, and kind of sit on them until they get to the front of the curve? Well, that is something a lot of people have figured out, and it kind of works until it blows up in your face. Well, why did it blow up in your face? Well, as soon as you have something like a pipeline spill that affects the physical market, even though it might not have a huge impact on flat price, it's going to blow up those time spreads at the front of the curve to massively high numbers. Yep. Well, okay, you can protect against that with calendar spread options. So there's a way to protect that. So I started developing a systematic strategy, which is based on some discretionary analysis, some fundamental analysis of the market, which is what are the factors that cause different parts of the curve to be in backwardation or contango at different times, and what are my expectations about where spreads are going to make that transition to being affected by one factor and then go into being affected by the other factor that puts the opposite pressure on them. It's never 100%, nothing in trading ever is, but there's a substantial edge to understanding the reasons that the back of the curve is affected by different things than the front of the curve. And all of this, by the way, changed completely with the USO ETF blowing up this past year. Because what's happened now is one of the reasons for that contango at the front of the WTI curve was because USO had this ridiculously oversized position in the front month. And not only did they have to roll it every month, but for some reason, nobody can figure out. They advertise on their website. They tell everybody exactly what the date is in advance for when they're going to roll that position. There's all kinds of people that make a fortune front running that. Yep. But one of the effects is all those front runners in the market are trying to push the curve into contango there so that they can make a buck front running the USO ETF. When USO changed its positioning, well, we still have contango at the front of the curve, but the change in direction of the curve that used to be very pronounced about 4 to 6 months out on the curve isn't as pronounced as it used to be. And I think that's because of USO shifting its positioning. So you've got to really understand a lot of different factors that drive this. But frankly, when I first started trading time spreads, I just knew that when the dipsy doodle was in the market, I didn't know what caused it. I had no idea why this crazy pattern was there. But I started saying, well, when it's there, you can make a buck by shorting time spreads about 6 months out and expecting them to decrease in price before they expire. Well, okay, let's go back and look at the history and say, if that's what happens when the dipsy doodle formation is in the term structure chart, what are the conditions that usually exist 6 months before that? And what are the conditions, what are the various times in history when those conditions have existed and that trade was working, and then it stopped working? Well, okay, go figure out what caused it to stop working and look for, how do I know when that's coming? And interest rates affect it because one of the things that goes on is people use that contango yield. The reason they're trading it in the physical market is because of what some people call collateral mining. They need an alternative to treasuries that can produce a treasury-like yield. So if people are in that trade and that's creating some of the contango at the front of the market, and then treasury yields improve to where treasury yields are a better deal, they're going to stop putting that trade on, and it's going to change the way the dynamics of my trade works. Took me a few years to figure that one out. All of this stuff, it's not like I'm the only guy who gets it, not by a long shot. But the people who know more about this than me are all pro-oil traders on prop desks that don't tell anybody how they do what they do. And, you don't have to be as good as they are. They're running billions of dollars. You've got the advantage of being smaller in size, that if you can figure out half of what those guys know, you've still got a huge edge, I think, over the guy who's just trading the front month contract on technicals, because there's just so many other people doing that. It's really hard to win at that game. And furthermore, crude oil has so much risk in it that big factors that can push the price huge overnight in either direction can happen out of nowhere because there's a war someplace or whatever. Generally speaking, when a trend starts where the whole market is moving from structural contango that we have right now toward structural backwardation, and we're not there yet, but it's the way we're headed. Once those trends are cast in motion, they usually take months to play out. And where we are right now, one of my favorite trades is long Z1, Z2, the long the December 21 contract, short the December 22 contract. I've been long that spread from minus 340, and right now today we're at minus 64 cents a contango. I think before we get to that spread, the front end of it expiring at the end of 2021, just over a year from now, we're going to be back in structural backwardation because by then the market will have rebalanced itself. I don't know how much, but I think it's not going to be a negative number. It's going to be a positive number. So I've just learned that trying to do what everybody else is doing is very hard to get edge. You want to do what the big boys know how to do, but you want to look for the trades particularly that they don't touch because their size prevents them from doing it. So there are trades that I've really focused a lot of my energy on to say, okay, what is it, and particularly trading further out on the curve than a lot of the pros do. If you go beyond about 18 months on the crude oil curve, There's just not enough liquidity in those markets for guys that are moving billions of dollars around to be active there. So the guys that are smarter than me, and by the way, those guys are a lot smarter than me, they've got so much money they're working that they can't be in parts of the market that I can be in. And I can be in places that retail guys that have as much money as I do don't know how to trade. And that to me has been the niche, and it's taken years to develop it.
So we have two new products coming out in the coming months. One product coming out actually October 5th is VOLQ. I'm really interested about this product. I know a lot of traders were tweeting about this and talking about this product, so we're probably going to start there today. But at the end, we definitely have to get into this water product that's going to be launched, the NQH2O. So we'll talk about that later as well. But let's start off with VOLQ. Give us the details.
Yeah, thanks, Anthony. And the team at CME Group and our partners over at Nasdaq are really excited about the upcoming launch of VOLQ futures on October 5th. For those of you out there who may not necessarily know what VOLQ is the underlying index that Nasdaq, our index partner, maintains and publishes. And the VOLQ index, it tracks the at-the-money focused approach to volatility measurement of implied volatility on the Nasdaq 100. The index itself is calculated based on the values of 32 cash Nasdaq 100 index options, where they take the two nearest in the money and out of the money puts and calls for the next 4 weekly expirations, so 32 options, and they use those to determine the implied volatility level of an precisely at the money option with 30 days to go to expiration. So what this does is this index is a measure of an at the money vol of the Nasdaq 100 index. CME Group, we are then introducing futures on this index on October 5th. The index itself has been around just for about 2 years, launched in October of 2018. And VOLQ futures therefore estimate the implied volatility of these at-the-money options with 30 days to go in terms of trading futures on it. Just like other futures products, the future is based on this index, and at any given time, the futures or the resultant trade prices of the futures will reflect an estimate of the forward volatility of the Nasdaq 100, which is the expected volatility of the index for a 30-day period that starts with the futures expiration date. So very, very similar construct and concept in terms of how the futures works. It's CME, it's cash settled, based on the VOLQ index. But the things to really remember about the VOLQ index is it is a at-the-money approach to volatility, which we've gotten great feedback from the marketplace on.
Is this VOLQ basically like the Nasdaq VIX?
That's a question we've certainly been getting from market participants and customers. And VOLQ is different than the VIX. I think two things really stand out. One is it tracks a different index. As everyone knows, the VIX tracks the S&P 500 index, and VOLQ will track the Nasdaq 100 index.
Yeah.
So when we look at that, I think particularly in the backdrop of 2020, the price difference or the price performance difference of S&P 500 and Nasdaq 100 has been quite stark at times this year. At one point, the Nasdaq outperforming the S&P 500 by more than 20-25% for the year. As such, and because of the different concentration of some of the stocks towards the top of those indices, if we think about the Nasdaq story stocks, there's a different underlying performance profile and therefore a different underlying volatility profile of those names and of that index. So this is not an either or decision between trading VIX and trading VOLQ. They can be traded alongside each other. They're complementary. They can be spread against each other if that's what you want to do. So there's lots of ways to use both. Or if you love the Nasdaq over S&P, you can just trade the VOLQ, right? So great to see there in terms of just it's a different way to trade volatility on a different index. The methodology is the second point, actually slightly different. So as we talked about, the VOLQ is an at-the-money approach to measuring implied volatility. It uses those 32 index options on NDX. There will always be 32 index options. The only change to which options are included is just a function of where is that at the money. What is the index price doing? Because the first two in the money and out of the money puts and calls is a relative location to at the money. So as the index moves, at the money moves, and then which 32 options included will adjust. But it isn't at the money. When you look at VIX, that is a variance-based approach to measuring volatility. It does not measure the at the money implied volatility. I think on average, it probably is more representative of the 30 delta puts. So when we look at it, when we think about how the index is moving, what is the at the money observation, and how, Anthony, we kind of always speak about how the market is moving. Naturally, we're already talking about the at the money approach, about what the index is doing. So this more closely aligns with how the market thinks about volatility, and very exciting to then overlay this onto something as exciting as the Nasdaq 100 index these days, which is continuing to have record years in terms of trading volumes, and in terms of the Nasdaq ecosystem. It only continues to grow here in 2020.
Yeah, a couple of things. First off, the growth in the Nasdaq was the first thing that came to my mind. We talked about how much the micros are trading now, the Nasdaq micros. I know that even myself, I've talked to you about this a bunch of times before. I am not somebody who really day trades the Nasdaq. I have now been swing trading using the Nasdaq micros, and I know a lot of other people that have come to the Nasdaq micros. It's just a product that's just talked about a lot. So I could see how the growth in Nasdaq products is getting new things like this. And the next thing I want to talk about is who comes up with this, right? I mean, because I'm thinking about this product right now that this VOLQ product, and I'm thinking, okay, how does this evolve? How does this even come to be a product?
That's a great question. And certainly we've talked about the Nasdaq before, and the Nasdaq remains a great product at CME Group, both in terms of the E-Mini varietals as well as the micros that everyone has grown to love on the Nasdaq, including yourself, having a great year with the micros trading, almost about 600,000 contracts per day.
It's crazy.
Here in 2020. I actually think we're up to almost 650,000, right? When we look through, today's the last trading day in September, so we're about 650,000 so far for the year through today, which is great. So when we look at how do we come up with products, or how do we look to kind of extend the product offering around the Nasdaq 100, this really is a testament to our great partnership with Nasdaq. CME and Nasdaq have a long-standing relationship that goes back to the 1990s. The Nasdaq used to be traded in the pits, and then the E-Mini Nasdaq, and now the Micro Nasdaq. And we renewed our partnership back in 2018 for the long term. And this is VOLQ has been one of the projects that we've been working on with them since shortly after that renewal. It's something they've been excited about. So it's really the result of collaboration with our index partners. But then at CME Group, our secret sauce that we always like to go to is customer validation. So we take this idea, we validate it with customers, we validate it with the marketplace. We really look for demand-driven innovation that clearly solves a well-articulated risk management need or trading opportunity in the marketplace. And VOLQ certainly ticks all that boxes. And us just kind of working the process at CME Group with our friends over at NASDAQ is really what led to the innovation around VOLQ. Launching on October 5th, we're very excited about it. So it's going to be a lot of fun. But I think one thing, and I think even you've heard some stuff from your listeners and your viewers out there, there seems to be a lot of interest in the NASDAQ. People are excited about trading volatility around it. And now they can do it in a futures contract, which is great. It's a linear product that gives you exposure to volatility, but you don't necessarily have to deal with some of the other nuances associated with trading options, including managing your delta, managing your vega, managing the resulting gamma of your positions. This is just, if you think volatility is going to go up, you can buy the future. It's going to go down, you can sell the future, and it works like every other future in the system.